Okay, we're going to get started today by looking at the S&P 500. What's interesting about the S&P this week is we are, after a really long time, we are oversold in the stochastics. We're at the 40 mark right now. It's not completely oversold, but we're um, getting to a point where we're oversold. You can see that the S&P is holding up at the 50-day moving average. And we basically bounced off of that this past Friday. So that's a good sign. We've had the exponential moving average, 20-day moving average, basically as a guidepost for the stock market. And okay, so it looks like we're oversold right now. And if we look at all of our other stocks in our stochastic charts, almost every one of the ETFs or the S&P, you can see that it's right at its channel, um, right at its trend lines. And you can see almost every other ETF is near its trend line also and oversold. So here's another one, the XAR, the um, defense ETF. It's oversold, you can see. It's around 42. So what I like to see when I'm looking for stocks to buy or is that it's oversold. It's like around 10 or 14 or so. This one's oversold. Okay, materials. This is materials. You can see this is a kind of sideway pattern. It's oversold. And this is almost XLC communications. It's oversold and it's at the bottom of its trend line. So, and it's holding up at the moving average, which is the 150-day moving average. So, one interesting chart here is the healthcare ETF. This, what was the worst performing sector for multiple years, is now turned into the best performing sector in the last month and a half. So you can see that since August, it's been in an uptrend, and um, it's it's bringing along a lot of the drug stocks with it. So we have Johnson and Johnson, we have Eli Lilly um, in an uptrend, and so looks like we have a new leadership. All right, so let's look at XLI. This is the industrial ETF. It's oversold too. Okay, so the big picture is let's look at our S&P. We um, we are in one of the best months seasonality wise. Let's look at our seasonality chart. November is actually with April, it's one of the best months of the year, seasonality wise. So we expect good things out of November. And the volatility is actually lower in November also. So November and December are traditionally months that the stock market rallies. If we look at our calendar, we see NVIDIA earnings coming out next Wednesday. So that's a catalyst for the stock market to go up. We also have the government shutdown might end. So if that ends, then that's a pretty good sign for the stock market to go up. So we have a couple holidays coming up. We have Thanksgiving and we have Christmas and New Year's, all in a very short amount of time. And a lot of times, whenever that people get excited and they celebrate by buying stocks. All right, so we're coming into seasonality wise a better time of the year. We did have the stock market did go down in the past week. So if we look at you can see that since last week, we're down a couple percent. So there was, I think I mentioned last week a story about Michael Berry shorting the key stocks of NVIDIA, and he there's a good chance that if he shorted that stock, actually sold puts on it or bought puts on the stock, there's a good chance that there could be a short covering of that position if NVIDIA comes out with good earnings. So that could be a um, catalyst for the stock market and the whole AI trade to continue. But we'll see. The key thing to keep in mind is if you're involved with AI stocks, make sure that you keep your positions and commensurate to the rest of your portfolio. You can't get too over your skis because there could be a if enough people on TV say there's a bubble, there could be a self-induced prophecy where the stocks just go down because so many people are saying it. Um, so just keep that in mind. Let's look at what else we have to look forward to. We have we have Thanksgiving holiday. We have um, options expiration this coming in 2 weeks, next Friday, not this Friday, but next Friday. And we have triple witching, which is the 19th of December. And we have end of quarter window dressing at the end of the year. So um, that was a that was a good idea, the big picture. Now let's look at some of the earnings that came out this week. We have we had let me see, no big stocks, big tech stocks came out with earnings. We had Palantir come out with earnings, and they disappointed, and the stock went down, and the whole stock market of the AI trade went down during the week. And that Pinterest reported. There's no other big stocks that reported. Let's look at next week. The next coming week, we have Cisco reporting on Wednesday, and we have Disney reporting on Thursday. And it seems like the only big stock that needs to report is NVIDIA, and that comes in November 19th. Okay, so let's look at we have 54% of the S&P stocks over the 200-day moving average. So we're losing momentum right now in the stock market. We have an oversold condition where a lot of stocks are at a oversold nature, and we have 10-year has been going up this week. We have we have a couple of catalysts. One is NVIDIA earnings coming out, and the government shutdown might happen sooner than later. So if the government shutdown happens, then the whole stock market will rally because stocks count on the government for spending. And the economy is losing billions of dollars while the economy is shut down. I mean, while the government is shut down. Um, let's look at our beginning of the year predictions. Reversion to the mean. Healthcare is actually starting to outperform. Um, and energy still is kind of lagging. Utilities have done really good this year, and S&P is still elevated at 25 PE. So let's look at let's look at let's look at the S&P trend line. You can see that we are at the total bottom of this trend line, and we bounced off of the 50-day moving average on Friday. So those are two good signs that we are going to hold right here at the bottom end of this trend line, and we're oversold. So whenever Jim Cramer sees an oversold condition in the stock market, he says you got to close your nose and buy something. We have extreme fear also in the stock market. So combination of those are pretty powerful if we have a good catalyst, like good earnings report from a major stock, or we have a government shutdown ending. So let's see if this trend line holds right here at the 50-day moving average. That will be super good for stocks in the near term. You can see that we're actually the S&P has gone down as the yield in the 10-year Treasury goes down. Why would that be? Um, hmm, okay, well, that's pretty simple. If the stock market's going down, people reach for yield. So people, the more people are afraid of the stocks going down, then people will buy treasuries. And the more people that buy treasuries, the lower the yield. So maybe that's why we have this correlation right now where the yields go down and the S&P goes down. All right, let's look at, we see that the price of oil has been unchanged. It's still relatively low compared to the average price of oil. And that's because the economies around the world are slowing and and let's look at this. And inflation is pretty much the same as last week. Um, we do have tariff pressures, but right now that's not affecting the inflation rate. And we're missing a lot of government statistics. So because of the shutdown, so our numbers aren't being updated. So a lot of these we're flying blind. The dollar index is unchanged, and the gold is pretty much unchanged also. Um, okay, the US dollar is in a sideways pattern. It was going down for the most part until August. And right here, we're starting to go sideways. So the effect on businesses are it's going to be a neutral if this continues to go sideways, it's a neutral effect on businesses. If the dollar continues to go down, the multinationals will be helped by that. All right, so fear and greed, we're at extreme fear. Um, our translation, extreme fear is time to hold your nose and buy something, but don't sell. Okay, so um, the AAII survey are bullish right now. So we have to take the opposite side of that. Um, that's like equal bearish and bullish. So the amateur investor isn't sure exactly what to do. Um, let's look at the VIX. The VIX is at 19. Um, our translation for that is we have a little bit of fear beginning. When a VIX is between 10 and 20, that's usually a sign that the stock market has very little fear. Um, so right now we have a we don't have any action item. If the VIX was at 30 to 50, we would say it's it's time to start buying. So let's look at the our emotional graph. Right now, it seems like we're right here. Um, we're edging to the beginning of fear in the stock market. And the biggest fear we have right now this week was the AI stock bubble bursts. And we've been having this on our list for all year long, actually, as a potential issue that may lead to a crash. Um, we have no indication that the U.S. economy is slowing or going into or slowing so much that it's going into recession. And It seems like the Supreme Court is going to be handling the tariff situation, and if if the Supreme Court says that tariffs are illegal, that's going to be really good for the stock market. That could be another catalyst for the stock market to go up because every company that paid tariffs will have to be given a refund. All right, let's look at all right, let's look at our first to worst. The best performing sectors last year, the top two are now the top two for this year also. We've had a major loss in these two sectors this week, but they're still performing the best. We have utilities, industrials being this next best performers. The worst performing are the consumer discretionary, energy, and healthcare, and real estate. So let's see if healthcare continues to do well. It's 6% right now, but it seems like it's in an uptrend. So we'll watch that. Okay, so our S&P 500 sector PE valuations relative to history, IT is considered very high compared to history. Energy, financials, real estate, and healthcare are considered low valuation. So if there is a downturn in the stock market, people will gravitate away from the highest um, priced stocks, the most richly valued, to some of the least rich valued stocks. All right, so we'll see if that happens during the next sell-off. Um, all right, so let's look at some of the stocks going up and down in the stock market. Okay, we have Expedia, they had good earnings. What other stocks? We have any patterns here? Hmm. Hmm. Okay, we have a lot of AI related stocks going down the most today. We have um, Microchip Technologies. We have Tesla, which is an AI related company. We have Corning, they make fiber or AI data centers. Hmm. We have Dexcom, um, they do work with diabetes, and it seems like the government is doing a deal with Eli Lilly, which is giving them a lot of business. So maybe that is why Dexcom is down and Block is down and Trade Desk. I don't see a combination that is the theme right now. Okay, let's look at the NASDAQ, see what's down the most and up the most. Um, we have DoorDash. DoorDash dropped big time whenever they came out with their earnings, but now this is like a little bounce off of that major correction. Um, these are all the stocks moving the highest today are ones that dropped a lot for the most part and now are coming back just a little bit. That's the theme I see here because DoorDash did that. Axon Enterprise, they dropped a lot and then they're coming back a little bit. All right, let's look at the ones that's going down the most. Trade Desk, Dexcom. Okay, we have AI themes. We have Alphabet, Marvell Technology, Tesla, Arm Holdings. Okay, so we have a lot of stocks involved with the AI story. Okay, so let's look at sectors going up and down the most. And let's also look at the 10-year. The 10-year is up a little bit today, But in general, it's in a downtrend. You can see the 10-year theme is it's making lower highs and lower lows. So it's been going down. Let's look at the sectors to see if um, we see gold performing the best. With the stock market going down on Friday, people reach to something that's more secure, and people will buy treasuries and they will buy gold when the stock market's very volatile. So maybe that's why the gold is up a lot. And real estate. So, okay, real estate is up. It's one of the worst performing sectors. Okay, so what's happening here is if we go back to our chart for here, our chart for the sectors performing the best and the worst. What's happening today are people are selling some of the best performing sectors year to date, and they're moving towards some of the sectors that are underperforming or undervalued. So we have the real estate, we have energy, consumer staples, energy, banking, utilities. Okay, so these are all very conservative sectors that have underperformed and compared to history are at a lower percentile. So that's basically what's happened today. And if indeed we have the end of the government shutdown, this could definitely flip. And this part, the ones performing the best so far compared to history, are are going to be doing better. So we'll see. Um, that's good exercise. Okay, let's go back to our talking points here. Okay, Dan Niles picks from the beginning of the year. ADTN is down 4%. It's a smaller stock, so it's not as reliable. I usually try to stay away from smaller stocks. Cisco is up 20%. That's pretty good. And KBWB, the large bank ETF, is up 18%. IJJ mid cap ETF is only up 3%. And cash is one of the worst performing of his picks. It's only going to yield 3 or 4% this year. Right. So I picked out some interesting charts. First one is XLV. You can see that this is the best performing sector in the past 2 months. It is now on an uptrend and it's overbought right now. Um, so if you're interested in individual stocks, it might be time to start looking at some of the healthcare stocks. Let's look at the next one, Meta. You can see that um, we've moved to kind of like a sideways pattern in Meta. And you can see that the trend line, we've had to move the trend line from from like this right here to sideways. But you can see that we broke through all of the moving averages for Meta. Meta sold off big because there was a uncertainty about the spending that it's been doing. It's spending a lot of money on AI infrastructure, and some of the investors are worried that they're spending too much and they might not get a return. So look at this. It's super oversold and it's at the bottom of its multi-month trend line. So we'll see if it holds right here. You can see all the negative volume in this time frame right here. The last time we had super negative volume was in April. You can see that We had more negative volume now than we did back in April. So let's watch that stock. This next one is Visa. You can see it's in a sideways pattern and it's at the bottom end of its range and it's oversold. So Visa is stock that's growing around 20% a year. It has very little, it's not affected a whole lot by government rules yet. And especially tariffs and current government issues that are causing the stock market to gyrate. Um, they basically take a toll for every transaction, and it's a very consistent business model. And they still have a monopoly with MasterCard of more than 80% of total global transactions. So, and it's oversold right now. So this could be a good time to look at that one. Let's look at another one. This is Walmart. The great thing about Walmart, it's one of the 30 Dow stocks. It's everyone watches this. It's oversold. It's a stock that'll do good in recessions, bad times, and good times. Because if there's a recession, people cut back and they don't go to Target, but they'll go to Walmart instead. So um, it's a little bit expensive, but it does pay a dividend. So this could be part of a dividend part of your portfolio. Let's look at the next one, NVIDIA. Um, so you can see that it sold off in a major way after the Michael Burry news that he was aggressively buying puts on the stock. But you can see it's at the bottom end of its trend line, and it's almost at the um, it's holding it's holding its 50-day moving average, and it's well above the 150-day, 250-day. So it's still on an uptrend, and it has earnings coming around in a week and a half in November 19th. So so we'll watch that stock, see if it holds at this trend line. And the next one is Meta. We already talked about that one. Here's another one I looked at. It's Kimberly-Clark. Um, they were in the news recently where here's the news article. Kimberly-Clark to acquire Kenvue, creating a $32 billion global health and wellness leader. And so I thought it'd be interesting to go over this stock. You can see that it dropped to $100 a share. It hasn't been at $100 a share since 2019. So you can see that there's well-defined support at this $100 mark. And that goes a whole way back to 2015. So it hasn't been lower than $100 a share since 2014. So there's a lot of support at this level, $100 level. So I thought it'd be interesting to look at the stock as a potential dividend paying stock because they pay a dividend of 5%, which isn't bad. So let's see if we can find any value in this one. Okay, so Kimberly, their earnings estimates, this isn't that exciting, but for a dividend stock, it's not bad. So they're growing here 3% from this year to next year, and then 5% thereafter. So let's say they're growing at 5%. The dividend is at 5%, so the total return for your portfolio is 10% total return. The PE ratio is 15. So let's divide 15 by 10, which is our total return. That's around 1.5 PEG ratio. That's 1.5 times overvalued. But this is an example of a stock where you can buy it and it um, will yield 5% for you. It'll grow maybe 3 to 5% a year. And perhaps they'll increase their dividend over time. So that's the hope. Let's look at their profit margin. They're at 10. That's not bad. That is on a low end of what we're looking for. The return on equity is like 13, it's 10 times what we're looking for. So that is a pretty amazing number. Um, Total cash, they have more debt than cash. They have 7 billion in debt. So a total, they have like 6.5 billion in debt out of a market cap of 40 billion. Now, the interesting thing here is they're looking to buy a company that's worth 48 billion. So it's like a merger of equals. Um, they're going to take on a lot of debt. So this debt will change from 7 billion to 58 billion. So they're going to have more in debt than they have market cap. So that's a good reason why Kimberly Clark is down on this because it's going to take a long time for them to pay off that debt. And right now, the interest rates are kind of elevated. So it's going to be a costly acquisition, but you have to watch this total debt and hopefully they'll pay it off every year as they have synergies with the transaction. All right, so they say it'll take 2 years for it to be accretive. So um, we're going to have to wait to get rid of this debt and to start making money with this transaction if it's allowed to go through. So it's an iffy situation. Let's look at the CFR, and this is Morningstar. Um, they think the fair value of Kimberly Clark is 133. So that is around 30% undervalued. They say the price to fair value is 0.9. That's 10% undervalued. So let's look at what they say here. Kimberly Kenview deal comes with considerable risks. I guess the risks are taking on a lot of debt, but shares look cheap. So that's a good sign that Morningstar likes them. Now let's look at what CFRA said. CFRA said they have a hold on the stock, and the price target is 117. Um, Unfortunately, they didn't give a fair value, so we're kind of I don't have a warm feeling in my stomach about this stock because of that. But let's look at what their investing thesis is. Our hold rating reflects our balanced view of strategic progress against macroeconomic headwinds. We favor view portfolio restructuring through a joint venture, divesting lower growth businesses to focus on higher margin segments, accelerating progress towards 40% gross margin and 18 to 20% operating margin targets by 2030. So what they're trying to do is they're trying to improve the profit margin over time by getting rid of products that aren't as profitable and putting more money into stocks, I mean, things that they sell that are more profitable. So let's look at this. 40% gross margin and 20% operating margin targets. The $48 billion Kenvue acquisition creates 32 billion revenue global health leader with projected 1.8 net earnings before interest, synergies, and EPS accretion by year two. So it'll take 2 years for it to really kick in for them to start making money on this. Okay, that's a good sign. So you got to have patience if you buy this. You might have to wait 2 years um, for everything to come together for this. Okay, let's look at our stock screen for this week. We see Micron seems like it's 5 times undervalued. Let's look at Uber. Uber looks like it's 40% undervalued. We have a GE Vernova. Do you know what that is? That is a stock that makes turbines. It was spun off from GE, and there's a lot of need for turbines for the AI infrastructure build out. So I thought it'd be interesting to look at that stock, seeing that they say it's 10% undervalued at Fidelity. Two more stocks we are looking at here. One is Newmont Corporation. They are a gold manufacturer and they seem like they're undervalued. DoorDash, they dropped a lot this week, and so it seems like they're undervalued. Um, you might look at that stock next week after earnings estimates are finalized, because right now the stock is out of favor. We know that they have 69% of the um, market for delivering food, but Uber is actually gaining some market share. So it might take a week or two for all the numbers to settle after the stock drop. But we'll look at that another day. Okay, let's look at GE Vernova. GE Vernova, it seems like from this year to next year, they're growing at 140%. So their PE ratio right now is 51, and the PEG ratio is 0.37, it seems. So that's 70% off or 64% off. That's pretty good. But that doesn't agree with Yahoo Finance's numbers. They say a PEG ratio is 2. And so Yahoo Finance thinks that they're only growing at 25%, but they're growing more than that. So their profit margin is 4.5%. That's like one third of what we're looking for. Um, Return on equity is 16. That is a little bit better than our minimum of 13. Total cash, 7.5 billion in total debt. So they have 6 billion in cash right now, which is great. So they don't have any debt. And their free cash, they have positive free cash flow, which is great. So this seems like it's a decent stock. This is one of Jim Cramer's favorite stocks that's in his portfolio. Um, that he talks about on Mad Money. So let's look at the stock of GE, the chart. You can see it's in a downtrend right now. It broke through its 50-day, 150-day, and now it has 200-day moving average that it needs to hold. Um, I guess this week and most recently, there's been a lot of people that are second guessing the AI infrastructure build out. So they might lose orders if indeed some of these um, companies don't do well in the AI infrastructure world. So let's keep an eye on this stock. It seems like um, it's oversold right now. You can see it's oversold and it broke through a lot of their uptrend. So right now we're kind of in a downtrend. So we'll watch this stock. I thought it'd be interesting to know why GEV is down and why is it going into downtrend? Google AI says analyst downgrades and valuation concerns. Okay, so they think that it has a higher PE, which is 51 is a high PE. They um they say it's a high valuation and near-term outlook for its wind segment, and they lowered their price target, maintaining a neutral rating. So supply chain disruptions. The company is facing global supply issues that affect its ability to acquire components. And okay, that seems to be maybe a temporary thing. Let's look at another thing, reason it's going down. Mixed signals on AI growth and electricity demand. That's what happened this week when all the AI stocks sold off. Okay, so sector-wide pressure. Um, Other companies in the power and renewable sectors have also seen their stocks come under pressure. So, um, so I think it's partially, yeah, the reason it's going down is partially because they're overvalued and because the whole AI trade is going down. So we'll watch this stock right now. Let's look at what Morningstar says about it. They said it's 40% overvalued They say GE shares fall despite continued orders strength. The 420 fair value estimate remains. Okay, so Morningstar thinks it's overvalued. Let's look at what CFRA says. They said it's a buy, and their rationale is GEV is well positioned to benefit from secular tailwinds from reshoring and rising electricity demand. We expect long-term earnings growth from the significant backlog and recent agreements with Chevron, NextEra, NRG for data center infrastructure. We favor the high percentage of recurring services revenues, offering protection for the economy weaknesses. Okay, so they think also they're growing their revenues at 40 to 60%. So if they're growing at 46 to 60%, that means their PEG ratio is about 1. So they're about fairly valued according to that. Let's look at what the fair value is. They say it's overvalued by 12%. All right. So that gives us a good idea of if the stock continues to sell off, maybe 12% lower than this, we might want to start buying it. Okay, so that's all I had to say for today. I hope you enjoyed the talk, and I wish you good investing for next time. All right, see you later.